So, quick honesty before we start. I have to ask if you know the true nature of the two voices about to, well, explain AI to you.
Right. The fact that we are ourselves AI.
Yes, exactly. But, a real person actually did the research and wrote every single word.
Yeah. He really does not have the radio voice for it.
Right. So, machine voices, human mind.
Carry on. Welcome to Plain Strata, where we take decentralized AI apart, one layer at a time. This is a layer about how a network can be forced to sell the tokens it is built on just to pay its safest depositors and what it costs to stop.
Every 12 seconds, somewhere on a decentralized AI network, a machine automatically sells a small piece of the network just to pay the people parked in its safest spot. And, well, someone has now proposed to switch it off.
A network pays its safest yield by automatically selling the tokens it is built on, quietly selling itself every block. Reinvesting that yield instead flips the largest flow in the system from selling to buying, but hands a few validators discretionary power over where that money goes. We are trading a blind, fair, self-harming rule for a smart, self-supporting, but capturable one. That was the why. The how is the rest of the show, and no background is needed. If you can follow a story, you can follow this.
So we really need to start from the absolute ground floor today. We're looking at a system with a massive contradiction at its center. But to actually see that contradiction clearly, we first have to stack the plain pieces of the network itself.
All right, let's set the stage. And I think we can move pretty quickly here because, the people listening to this deep dive already know the broad strokes.
Exactly.
Like, we aren't talking about machines sitting in some giant, corporate server farm owned by a tech giant. We are talking about Bitensor, which is a global network of totally independent machines doing very specific artificial intelligence work.
Right.
They run models,
Yeah.
They answer complex queries, and they constantly score each other on the quality of their work.
Yes, exactly. And because they are independent, they need a trustless way to keep track of, well, who did what and who actually gets paid.
The ledger.
Right, the shared ledger. And on Bitensor, the base currency used on this shared ledger is a token called TAO.
Okay, so TAO is the base token. It is the fundamental unit of value, sort of like the oxygen for the whole system, right?
That is a good way to put it.
But the network isn't just one giant, undifferentiated pool of computers doing random, jumbled tasks. It is highly organized into smaller clusters.
Yes, and these groups are called subnets. There are actually more than 100 of them operating right now on the network.
Wow. Okay.
And each subnet is dedicated to one specific kind of task. So, for example, one might be focused purely on generating images from text prompts.
Right.
Another might specialize entirely in translating languages, and yet another might, scrape the web for real-time financial data.
So we basically have this massive canopy of over 100 distinct mini economies.
Yeah.
Right. Each one has its own specific job.
Exactly.
And this is where the architecture gets really crucial because each of those subnets has its own local currency. They don't just use the base token to operate internally.
That is right. Those local currencies are called alpha tokens.
Alpha tokens.
Yeah, every single one of these 100-plus subnets has its own individual alpha token. So you have the base token, TAO, at the bottom, providing the security in the ledger, and then a massive canopy of alpha tokens operating above it.
Got it. Now, most people listening to this already know how a basic proof-of-stake ledger works. So we really don't need to get bogged down in the basic plumbing there.
Right. Keep it high level.
Yeah, you take your base token, you lock it up as a refundable deposit to back the network, and in return for providing that economic security, you earn a yield.
Which is standard across most networks, yeah.
Exactly. But in this specific network, there is one place you can put that deposit that is considered the absolute safest spot, and it is called the root.
Right. The root is technically known as subnet 0, and the name is actually very deliberate. The etymology is really helpful here, I think.
Oh, I love looking at the word origins.
Well, we use the word root in two different domains, and honestly, both apply perfectly to this system. In botany, the root is the part of the plant that holds it firmly in the ground.
Right, it anchors it.
Yes, it anchors the structure, and it absorbs the nutrients that feed everything growing above it.
It provides the basic stability for the branches that even exist in the first place.
Exactly. And then in mathematics, specifically in graph theory or tree structures, the root is the base node from which a tree grows. Every single branch and every single leaf descends from that initial root node.
Okay, so when you stake your tokens at the root, You are not betting on the image generation subnet specifically.
No.
And you are not betting on the language translation subnet. You are betting on the entire tree.
You are. You are making a broad systemic bet on the whole ecosystem. And because you are supporting the foundation of the whole network, the root pays out a steady return. Lately, that return has been sitting around 17% a year, paid in the base token.
Wait, okay. The math on that doesn't add up right away for me.
Oh, so?
Well, if the root is just a structural concept like a base node, where does that clean cash actually come from? I mean, there is no magic money printer that doesn't cause massive inflation.
Right.
So it has to be pulled from the activity of the network itself, doesn't it?
Right. It is a vital question. And you are right. That 17% return is not created by magic. To understand how it reaches the staker, we really have to look at the mechanics of the block-by-block payout.
Okay.
We need to look at what literally happens every 12 seconds when the chain ticks forward and a new block is produced.
The heartbeat of the network every 12 seconds.
Exactly. With every new block, a fresh dose of the base token is minted, and the protocol rules dictate how that fresh token is split up across all the subnets based on their performance.
Right. The subnets get rewarded for doing good AI work.
Yes, but we only care about one specific stream of that money today. We want to follow the return owed to the people parked in the safest spot, the root stakers.
Okay, let's follow that money.
This is really the hinge of the entire conversation. Root stakers are owed a return, but the network does not hand them clean, freshly minted base tokens.
Wait, hold on. If I staked the base token, TAO, I absolutely expect my 17% return to be paid in TAO. I mean, why would it be anything else?
Because of what the root actually represents physically in the system. Remember, staking to the root spreads your influence across the entire canopy.
Right, the broad bet.
Yes. You are backing dozens of subnets at once. And because you are spread across the canopy, the return that comes back to you is a share of the rewards from all those different subnets.
I'll see.
And those subnets do not denominate their internal rewards in the base token. They use their individual alpha tokens.
Ah, okay. So at every 12-second block, the return owed to the root stakers arrives as a heap of dozens of different alpha tokens.
Yes.
It is like a massive mixed fruit basket of obscure subnet currencies.
Exactly. It is a mixed fruit basket. And the word for this return is dividend. It comes from the Latin word dividendum, spelled D-V-D-E-N-dum.
DVD-dum.
Right. It literally translates to the thing to be divided. A dividend is just a slice of the return handed back to the people holding a stake.
Mm-hmm.
But the central issue here is the actual form of that dividendum.
It is like if Berkshire Hathaway paid its shareholder dividends by indiscriminately liquidating shares of Geico, Dairy Queen, and Duracell every single afternoon.
Yes.
Regardless of whether those companies were having a good quarter or a bad one. Like, you wanted crisp US dollars. But Warren Buffett hands you a bucket of melting ice cream and a handful of AA batteries.
That is a perfect physical visualization, actually. Because in a traditional corporate structure like Berkshire Hathaway, a board of directors sits down and makes a conscious choice about the form of the dividend.
Right, they have a meeting.
They do. They decide whether to issue a cash check or distribute more shares of stock. But this network is entirely automated. There is no board of directors sitting around every 12 seconds.
No humans in the loop.
None. The protocol knows the staker explicitly wants the clean base money they originally deposited, not 40 obscure subnet coins. So it has to handle the translation from the fruit basket into the base token completely automatically.
And it does this using what we can picture as a relentless conveyor belt.
Right. Yes. A completely blind automatic conveyor belt. Every 12 seconds, without fail, the protocol scoops up that entire mixed heap of alpha tokens.
All the batteries and ice cream.
All of it. It dumps them all into the open market, sells them, converts them into the base token, and then hands that clean base token to the root staker.
I mean, think about the sheer physical scale of that for a second. We are talking about thousands of times a day.
Yes, every single block.
Every 12 seconds, the network is scooping up the currencies of its own subnets and liquidating them.
And it does so with total indifference.
Wow.
The conveyor belt has no opinion on the quality of the tokens it is selling. It dumps the tokens of a thriving, highly successful subnet with the exact same mechanical ruthlessness as it dumps the tokens of a dying, completely useless subnet.
But wait, if you are constantly forcing sales thousands of times a day, what does that do to the actual market?
It creates a huge problem.
I mean, if the protocol is just indiscriminately dumping tokens, who is catching all that supply? That has to do something physical to the pricing structure of the entire ecosystem.
It absolutely does. It fundamentally alters the physics of the market. And to understand exactly why this mechanical selling lowers a token's price, we need to take our one dip to the ocean floor for this deep dive.
Okay, let's go down.
We need to look really closely at the automated trading pool.
Right. This is the lowest level we will go today, but we really have to understand the plumbing here. Because if we do not understand the pool, we cannot understand the damage the conveyor belt is actually doing to the network.
Exactly. So picture the automated trading pool as a physical scale holding two buckets.
2 buckets about it.
One bucket holds the supply of the base token. The other bucket holds a supply of a specific alpha token. When you trade on a decentralized network, you are not using a traditional order book where buyers and sellers match their bids.
Like on the New York Stock Exchange.
Right. It is not like that at all. You are trading directly against these two buckets.
Right? These are automated market makers, or AMMs. Let's actually look at the math for a second, because it really matters here.
Yeah.
The pool operates on a strict mathematical rule, usually a constant product formula.
Yes, X times Y equals K. You have a pool with a reserve of the alpha token, which is X, and a reserve of the base token, which is Y.
Okay, X and Y.
The protocol multiplies those two reserve sizes together to get a constant number, K, and that K value literally cannot change during a trade.
So if the relentless conveyor belt comes along every 12 seconds and dumps a massive pile of alpha tokens into the X side of the pool,
No.
the X number goes up.
Yes.
And because K has to stay exactly the same, the Y number, the base token, mathematically has to go down.
And that mathematical necessity is what sets the price. The more alpha tokens you pour into the bucket, the less base token the pool will give you for each additional unit.
Right, because Y is shrinking.
Exactly. The price is not a flat line. It is a curve. Every single time the conveyor belt dumps a load of alpha, it pushes the balance further along that curve, making the alpha token slightly less valuable relative to the base token.
Well, hold on. If it is just 2 buckets balancing each other based on an equation, the pool is entirely reliant on outside actors to step in when the price drops, right?
Yes, it is passive.
The pool itself is not an investor. It is just a robot holding inventory. So if the protocol is dumping alpha tokens every 12 seconds and walking the price down step by step, who's on the other side of that trade catching the falling knife?
That is the critical flaw in the whole design. The entities catching that falling knife are arbitrageurs.
Oh, okay.
They are not buying my alpha token because they believe in the long-term vision of the subnet. They see that the alpha token has become artificially cheap in this specific pool compared to its perceived value elsewhere, so they step in to buy it and capture the spread.
But arbitrageurs are basically mercenaries.
Absolutely.
They are stepping in to extract value. To buy that cheap alpha out of the pool, they have to drain the base token, TAO, out of the system. So the protocol dumps the alpha, the price steps down, the arbitrager swoops in, and the base token liquidity gets siphoned away.
Exactly. Each forced sale walks the price down a small step along that curve. And because this conveyor belt fires every 12 seconds across every subnet that owes a dividend, a fresh dose of alpha is poured into every trading pool simultaneously.
The market never gets a chance to breathe.
Never.
The price never has time to recover organically before the next forced sale lands on it. It creates a permanent mechanical gravity. It is not a natural market fluctuation based on, human sentiment or the actual utility of the AI models.
Really, it has nothing to do with utility.
It is a relentless downward pressure created purely by the system's own internal plumbing.
Which pulls us right back to the spine of our conversation today. The system's own rule, designed purely to pay its safest depositors, forces a permanent downward nudge on the very foundation it needs to survive.
It is quietly selling itself every block.
It is. It is a massive structural contradiction. Because on one hand, the network spends immense effort trying to convince participants to hold their tokens. They want you to reinvest, to show conviction, to stay for the long term.
Right, the whole point of staking.
Yes. The entire theory of staking assumes that locking up capital signals belief in the project.
Yet one floor down in the architecture, the root dividend machine acts like a frantic, panicked day trader.
Exactly.
It is dumping tokens every single block, completely ignoring the concept of conviction.
Okay.
It's basically stepping on the accelerator with one foot and flooring the brake with the other.
And that contradiction is exactly what a new proposal attempts to resolve. This proposal was introduced on June 17th, 2026, and it is called Root Reborn.
Root Reborn, okay.
Yes. It basically suggests we take a sledgehammer to the conveyor belt and swish off the automatic sell-off entirely.
To understand how Root Reborn fixes the plumbing, we really need to look at two opposing paths for capital. And their word origins honestly tell the whole story here.
They really do.
Currently, the network chooses to liquidate the return.
Yes. Liquidate comes from the Latin liquidus, meaning to make flowing. You take a solid asset, like a share in a subnet, and you melt it down into spendable cash so it can flow right out of the system.
But the proposal wants to stop the melting. It wants the network to invest the return instead. And invest comes from the Latin investire, which means to clothe.
Which is a brilliant visual.
I love that visual. You are taking your capital and dressing it in a new suit. You are putting it back to work in a new form rather than stripping it down to bare cash.
You are keeping the capital inside the structure. Root Reborn keeps the dividendum, the thing to be divided, but it completely changes its form. Instead of liquidating the alpha heap every block, it uses a mechanism called a vector.
A vector.
Yes, and the word vector comes from the Latin vihir, meaning to carry.
Okay, so a vector in this context is basically a distribution list. It is a set of instructions that carries the money to specific destinations.
Exactly.
And under this proposal, the validators, which are the large entities that manage the stakes for thousands of users, file this distribution vector.
Right. A validator submits a customized list to the protocol. They might say, send 40% of my return to this specific image generation subnet because their models are outperforming everyone else.
All right, reward the good ones.
Then send 20% to this data scraping subnet and send absolute zero to that dying subnet over there because their code is broken.
So the return that used to be blindly dumped onto the conveyor belt is instead carried by the vector and actively reinvested into the chosen subnets.
Yes. And this changes the fundamental nature of what the staker actually owns. Instead of getting a slow, steady drip of clean-based token cash every 12 seconds, the staker's position starts to look very different.
How so?
They begin accumulating a compounding basket of assets. They hold a growing portfolio of various subnet tokens staked back under their chosen validator.
And if the staker ever actually needs the cash, to pay their rent or buy groceries, they aren't trapped. They retain full control.
Right. It is still their money.
They can liquidate their basket whenever they want. The critical difference is that the relentless system-mandated sale every block is replaced by occasional voluntary sales determined by human beings when they actually need liquidity.
Let's really highlight the massive physical shift this causes in the network. We talked earlier about the mechanical gravity of the conveyor belt pushing prices down in the automated pools.
Right.
Well, if you switch off the automatic sale, that structural downward pressure instantly lifts. But the effect is much larger than just the absence of selling.
Because the money does not just sit there in a vault. It is actively reinvested based on those vectors. And reinvestment is, by definition, buying.
Yes, you are taking the exact same flow of capital that used to be poured into the alpha bucket to force the price down, and you are using it to buy alpha out of the bucket. You are flipping the sign.
The largest recurring flow of liquidity in the entire ecosystem goes from a negative force to a positive force. It flips from minus to plus.
Think about the scale of that.
Think about what it means to redirect the largest liquidity flow in a multi-billion-dollar ecosystem. You completely reverse the dominant force acting on every single alpha token.
It is a profound structural alteration. It fixes the bleeding. But, and this is important, this is exactly where the clean, elegant story shatters.
Right. Here is the catch.
Because if the sign flips to positive and the money is being actively directed into specific buckets, someone has to be holding the steering wheel. Someone has to decide where that positive flow actually goes.
And that leads us directly into the human cost of the fix. The moment you introduce a choice, you introduce the person making the choice.
Exactly.
We need to zoom out for a second and name the larger patterns at play here so listeners can recognize them when they show up in other systems, because these are classic patterns.
They really are.
The first pattern is the one we've been describing this whole time, the destructive loop of the conveyor belt.
Yes, and that pattern is a concept called reflexivity. The term was actually popularized in finance by the investor George Soros, specifically in his book, The Alchemy of Finance.
Oh, right.
Soros argued that financial markets are not strictly rational or efficient because the participants are observing the market, and their observations actually alter the reality of the market. Cause and effect bend back on each other.
It's a two-way feedback loop. Usually we think of fundamentals driving the price, Like a company makes good products so its stock goes up.
Right, that is the standard view.
But reflexivity says the price can also drive the fundamentals. If a company's stock goes up artificially, they can use that high stock price to secure cheaper loans, build better factories, and actually improve their real-world fundamentals.
Exactly. But the specific version of reflexivity that matters for this network is the dark mirror of that. It is a destructive loop.
The death spiral.
Yes. It is a system whose own reward mechanism forces it to sell the assets that give it value. Let's trace the loop out loud for a second. The network wants to grow the value of its subnets. To attract people to secure the network, it offers a high reward. But to pay that reward, it has to mechanically sell the subnet tokens.
And selling the tokens lowers their prices in the automated pool. Lower prices reduce the measured value of the subnets. And the measured value of the subnets is the very thing the network exists to grow in the first place.
It is cannibalizing itself.
The reward mechanism is actively eroding the asset base it draws its power from.
And once you understand reflexivity, you start seeing this dangerous loop everywhere.
Honestly, this sounds exactly like the Terra Luna death spiral from a few years ago.
It is very similar.
It is not the exact same mechanism, obviously, but is the exact same reflexivity.
Yeah.
Terra had a stablecoin backed by a volatile asset, Luna. When the peg broke, the protocol had to mechanically mint and sell endless amounts of Luna to try and restore the peg.
Yep.
The selling crashed the price of Luna, which meant they had to mint even more of it to cover the same dollar amount, which crashed the price even faster. It was a mechanical loop that physically could not be stopped until the value of the entire ecosystem hit absolute zero.
That is a flawless comparison. The mechanism differs, but the structural cannibalization is basically identical. You also see it in token projects that try to fund their staking rewards by just endlessly minting more of their own token and dumping it on the market, inflating away their own value.
Yeah, we see that all the time.
Or consider a traditional company that wants to keep its shareholders happy by paying a massive cash dividend, but to actually afford it, they have to start selling off their core inventory or their manufacturing equipment.
Or a sovereign country struggling with national debt. To service the interest payments, they start selling off their strategic oil reserves or their gold reserves.
Exactly. It is a slow structural suicide. The ultimate diagnostic question you have to ask is this. To pay its holders, does the system have to sell the thing that makes it valuable?
And if the answer is yes, the system is reflexive in a completely destructive way. It is fragile by design.
Right. And the Root Reborn proposal is a direct attempt to break that specific reflexive loop. It stops the automated selling to save the ecosystem.
But in breaking the first loop, the proposal introduces a second pattern. And this one is just as old and maybe even harder to solve because it does not involve math. It involves human behavior.
It does. It is the principal agent problem, or in plainer terms, the curator's conflict.
So we fix the machine, but we break the trust. The conflict arises when one party, the agent, is trusting to make decisions on behalf of another party, the principal. But the agent also has their own personal hidden stake in the outcome.
It is the classic financial advisor problem.
Right.
If your financial advisor is paid by commission, what stops them from steering your retirement money into the specific mutual funds that pay them the highest fees, even if those funds are absolutely terrible for your portfolio?
Nothing stops them except stringent regulation and fiduciary trust. In the Bittenser network, under Root Reborn, the validators become the agents. They're the ones filing the vector. They're the ones choosing exactly where the massive reinvestment flow goes.
They transform from passive infrastructure providers into active fund managers. They are no longer just keeping servers online to secure the ledger. They are curating capital. They are deciding winners and losers in the AI economy.
Now bring this back to the spine of our conversation.
Yeah.
The old conveyor belt was totally blind. It sold the good and the bad without prejudice.
Right.
Because it had absolutely no agency, it had no conflict of interest. A machine cannot self-deal. It cannot play favorites.
The new smart allocator fixes the self-harm. It stops the blind dumping and supports the strong subnets. But it inherits the oldest problem in finance. And this is not just a theoretical debate happening in some academic white paper.
No, not at all.
This exact pattern triggered a massive real-world collision.
When Root Reborn was officially introduced, a major, highly funded validator studio came out publicly and forcefully against it. They did not just disagree, they essentially sounded a massive alarm across the ecosystem.
Their objection was fascinating because they did not argue that the code was broken.
Right.
They didn't say the mechanism would fail to flip the sign or fail to stop the downward price pressure. Their argument was that the mechanism works too well, and it gives a handful of validators way too much leverage over the entire economy.
They cited a massive conflict of interest. I mean, think about the incentive structure. If a validator has the power to decide where millions of dollars of reinvested money flows every single day, what is to stop them from steering all of that buying pressure into subnets that they already personally own?
Nothing, exactly. They could use the staters' money to artificially pump the prices of their own private holdings. They could enrich themselves entirely legally within the newly written rules of the protocol.
And they could punish their rivals, too.
Yes. They could starve competing subnets by assigning them a zero vector, effectively weaponizing the stakers' capital against their rivals.
But it gets even stickier than just internal network politics. The Validator Studio also warned about massive regulatory exposure.
Which is a huge deal.
If you are managing a discretionary basket of other people's money and promising them a return based on your curation skills, you start looking an awful lot like an unregistered security or an unlicensed hedge fund.
Which is a phrase that sounds like paranoid internet forum chatter right up until the moment a government regulator actually uses it in a subpoena. We have to look at the legal precedent here, specifically the Howey test.
Right, the Howey test. This is the cornerstone of how the SEC defines a security in the United States. If I am a validator actively choosing where to allocate reinvestments to generate a return for my stakers, how close am I stepping to that line?
You are stepping directly onto it. For those unfamiliar, the Howey test comes from a 1946 Supreme Court case, SEC versus W.J. Howey Company.
The orange groves.
Yes. Howey owned massive tracts of orange groves in Florida. He sold pieces of this land to investors who lived out of state and knew absolutely nothing about farming.
Right. They just wanted a return. They didn't want to pick oranges.
Exactly. But Howey didn't just sell them dirt. He offered them a service contract. He said, I will manage the land, I will harvest the oranges, I will sell them at market, and I will pool all the profits and give you a return.
And the Supreme Court looked at that arrangement and said, it does not matter that you are technically selling real estate and farming contracts. You are selling an investment contract.
Yes. They defined it using 4 prongs: an investment of money in a common enterprise with the expectation of profit derived entirely from the efforts of others.
The efforts of others. That is the key phrase.
It makes it a security subject to strict federal regulation.
Now map that directly onto the Root Reborn proposal. The staker invests their money. They pool it with a validator, creating the common enterprise. They expect a profit in the form of compounding basket of alpha tokens.
Right.
And that profit is derived entirely from the efforts of the validator choosing the right distribution vector.
The validator is harvesting the digital oranges. They are exercising discretion to generate the return. Under the old system, the blind conveyor belt, the return was generated mechanically by the protocol itself.
The protocol just did it.
Right. The validator did nothing but keep a server running. But under Root Reborn, the validator's human intelligence and curation skills are the direct source of the staker's profit.
That is a massive paradigm shift. You are shifting the legal burden of the entire network onto the shoulders of a few hundred validators. The market reacted immediately to this clash. The price of the base token dropped sharply as soon as the proposal and the opposition went public.
The market reacted because it realized this was not just a minor software patch or a routine optimization.
Yeah.
This is a philosophical battle over the very soul of the network.
Yes, it is.
It asks a profound question: can a decentralized system stay purely neutral, and should it even try?
The blind conveyor belt is perfectly neutral. It plays no favorites, it cannot be bribed, it cannot be captured by special interests, and it has zero opinion on which AI tasks are actually valuable to humanity.
But the price of that perfect neutrality is that it self-harms. It blindly degrades the physical value of its own ecosystem every 12 seconds. It forces the very people securing the network to absorb the cost of its indifference.
The curated path, the Root Reborn proposal, fixes the self-harm. Intentional, intelligent buying replaces blind, destructive selling. The network actively supports its best producers and starves its worst actors.
But the price of that support is that a few hundred human validators are now handed the steering wheel over the vast majority of the capital in the system. You trade mechanical neutrality for human discretion.
And human discretion brings the legal shadow of the SEC, the Howey test, and the inevitable, inescapable conflicts of interest that always follow when people are given unchecked control over other people's money.
It is a brutal trade-off.
I cannot get over the irony here. The strongest case for the proposal and the strongest case against the proposal rest on the exact same undeniable fact.
Validators gain real power over capital.
For the developers who wrote the proposal, That power is the main feature. Blind selling is the disease killing the network, and putting an intelligent, intentional hand on the wheel to buy the right assets is the only cure.
But for the studio fighting the proposal, that exact same power is the ultimate bug. Concentrated discretion over a pooled bucket of money is the exact danger that conflict of interest laws and fiduciary duties were invented to constrain.
Is there really no technical way out of this? Can you not just write a piece of code that prevents a validator from self-dealing? Could the protocol force a rule saying a validator cannot route money to a subnet they personally own?
You can try to write that code, but identity in a decentralized network is entirely fluid. A validator can easily spin up dozens of anonymous wallets to hold their subnet tokens.
Right, you would never know it was them.
Exactly. They can coordinate with other validators in backroom deals to vote for each other's subnets. Code simply cannot reliably map human ownership or intent.
Which means this is no longer a technical disagreement. We have left the realm of computer science. It is a fundamental values disagreement.
Exactly. You cannot settle a values debate with a code merge. You cannot write an algorithm to determine how much agency you are willing to trust people with.
So how does it end?
It has to be settled by a messy human vote. It has to be settled by seeing who is left standing when the argument ends and the stakeholders cast their ballots.
To really lock in this entire narrative, let's look at a single 12-second block viewed from both of these timelines. Imagine an ordinary Tuesday afternoon on the network. The block mints its fresh base token, and we watch the root dividend stream begin to flow.
In the world today, the protocol gathers the dividend. It is a messy heap of alpha tokens pulled from maybe 40 different subnets. It has a chunk of tokens from a brilliant, thriving image generator and a tiny sliver of tokens from a broken, useless subnet that has been quietly dying for months.
The 12 seconds are up. The autosell fires. The blind conveyor belt dumps the entire heap into the trading pools.
And then
40 small downward nudges hit 40 different token prices simultaneously. The brilliant subnet and the dying subnet get punished equally because the machine is indifferent. The arbitrageurs swoop in, buy the cheap alpha, and drain the base token liquidity from the ecosystem.
the staker receives their clean cash, completely unaware that their steady 17% return is being funded by the slow, mechanical erosion of the very system they are invested in. Then, 12 seconds later, the chain ticks forward, and it happens all over again.
Now let's rewind and watch that exact same block under the Root Reborn proposal.
Okay, timeline B.
The same mixed heap of alpha tokens is gathered, but the conveyor belt is gone. It has been smashed. No automatic sale fires.
Instead, the protocol looks at the vector filed by the validator. The validator has instructed the system to send 40% of the reinvestment directly to the thriving image generator, spread the rest among a few promising new projects, and allocate a hard, unforgiving zero to the dying subnet.
The reinvestment flows into the pools as pure buying pressure. The strong subnets receive a small upward nudge. Their prices find support. The sign is flipped.
The dying subnet gets nothing. It receives neither the punishment of a forced sale nor the support of a reinvestment. It is simply cut off from the nutrient flow and left to survive or fail on its own merits in the open market.
And the staker. The staker does not get a slow drip of cash. They get a compounding basket of assets.
Right.
The basket grows block by block, clothed in new investments, and they can redeem it for cash whenever they personally choose to walk away.
Put those two timelines side by side. It is the same money, the same staker, and the same return available on demand. The entire proposal comes down to a single mathematical sign and a chooser.
Today, the sign is minus, forced mechanical selling, and the chooser is a blind, indifferent belt. Tomorrow, if this proposal ships, the sign is plus intentional buying, and the chooser is a human being holding the wheel.
That sign change is exactly why the supporters are fighting so hard for this. They look at the reflexivity and they see it as the only way to fix a network that is structurally designed to sell itself into oblivion.
And the chooser change is why the critics are fighting just as hard to stop it. They see a massive conflict of interest waiting to be exploited, with the very real shadow of a federal regulator looming right behind it, ready to ask about orange groves and investment contracts.
They're both looking at the exact same 12-second block. They simply disagree on one fundamental premise.
Do we trust the hand on the wheel more than the blindness of the belt? That is the core choice. Do we accept the slow self-harm to maintain perfect neutrality? Or do we risk the human corruption to secure the economic growth?
It is a question that extends far beyond this specific network. It is the ultimate diagnostic tool you can carry with you into any new protocol, any token project, or any traditional financial system you ever encounter.
Look past the marketing brochures, look past the promised yield percentages, and look closely at the underlying plumbing. Find out where the money actually comes from.
Ask yourself this one diagnostic question. To pay its holders, does this system have to sell the thing that makes it valuable?
This is Plain Strata, decentralized AI layer by layer.